The S&P 500 is at record levels. Gold touched $3,700 an ounce today, and the Fed is meeting right now as we speak and as we're recording this. I'm bringing back a fantastic guest that we had on in January. It's Louis Gave. He received rave reviews for his commentary. We talked around the AI bubble back then and to the DeepSeek, or the introduction of DeepSeek to the world and how it caused disruption. We're going to continue that conversation, see how AI is shaping the meta and macro landscape right now, but we're also going to talk about of course, the Fed. We have to mention it. What are the expectations? Can we expect a rug pull tomorrow, meaning Wednesday? And what is happening between the U.S. and China? Trade talks are happening in Madrid, and China stopped shipments of germanium. So they're already playing the game, and they're not playing it easy. So they're making it hard for everybody. So I'll be curious what his thoughts are on those topics. Before I switch over, hit that like and subscribe button. It's a free way to support our channel, and we much appreciate it. Now, Louis, it is great to have you back on the channel. It's good to see you again.
Good to see you, Kai. Thanks for having me.
Yeah, really looking forward to this. We got rave reviews of the last interview, so I'm really excited to have you back on, Louis. Let's start right at the beginning. Like maybe connect this interview with the one we did in January where we talked about the DeepSeek crash and the impact of DeepSeek. Maybe let's discuss or set the scene here by just discussing the role of AI in the meta and macro landscape that we are in right now. What has changed over the last 9 months here?
Look, I think it's a great place to start. To be honest, AI, the hype, the excitement really started back in November 2022. If you go back then, the total U.S. market cap was $40 trillion. We're now at about $65 trillion of market cap. So that's $25 trillion in a little less than 3 years. It's simply unprecedented. The wealth creation, and not all of that has been AI, of course, but essentially, most of that wealth creation has occurred in the top sort of 50 U.S. stocks. You look at your Russell 2000, you look at your S&P 600 small cap index. They've barely done anything. So the wealth creation has occurred in the U.S. top market caps, and I think what's unfolded essentially is today the U.S. sends more dollars abroad than it ever has. Right now the U.S. current account deficit is 6% of GDP. Concretely, that means that the U.S. sends 2 trillion banknotes, like 2 trillion little dollars to the rest of the world. And the rest of the world gets these dollars and like, what am I going to do with these? And I think for the past almost 3 years now, the view has been, well, I'm going to reinvest them in U.S. equities. I'm going to reinvest them in the S&P 500 because the U.S. has companies that do things that nobody else does. So AI has perhaps been the one differentiating factor of the U.S. relative to everybody else. And that's why I think it's a great place to start this conversation, because inherently, I think we're now getting to the point sort of 3 years into this AI boom, hundreds of billions of dollars being spent in CapEx, where increasingly we're going to have to see whether these investments actually provide returns. The hundreds of billions of dollars that Facebook, that Google, that Microsoft, et cetera, invested, does that deliver profits to the bottom line? Yes or no? If yes, then happy days. This CapEx all made sense. Productivity gains are here. The U.S. is exceptional, et cetera. If it turns out no, if it turns out that all this money was essentially lit on fire, that the productivity gains and more importantly, the profitability isn't that great, and I think there's increasing signs that this may be the case, then all of a sudden you've got a quandary in that, well, why am I going to keep redeploying capital in the U.S. if they're just going to, light it on fire? So the AI, I think we're at a super important juncture. If essentially AI has been a bubble, and if it, bursts in the coming year, that means most likely that the dollar's got another massive leg down, that U.S. equities have a big leg down. Again, 25 trillion in sort of wealth creation in 3 years is unprecedented. So the AI question is an all-important question. I would go even one step further. When you look at the mega trends, perhaps reshaping our markets right now, one of them is AI. Is AI going to change the world or not? The other mega trend that you and I also discussed is the question of whether. Sorry, I don't know what just happened here. The question of whether welfare states are essentially at the end of their road, whether we can keep expanding debt forever. France, Britain, US can keep running budget deficits of 5-6% of GDP. And then I think there's another huge question that's now coming to reshape our world, which appeared sort of 2-3 weeks ago, is the new cooperation between China, India, and Russia. Because if those three countries start getting along much better, then all of a sudden you're uniting the guy with the cheapest commodities, the cheapest capital goods, the cheapest cost of capital, and the cheapest labor. You put those three together, you got a boom of epic proportion. Now, interestingly, when you look at a top 30 companies in the stock market today, out of the top 30 companies, 24 are American, and a number of them, especially in the top 10, are all in on the AI boom. If you look at your top 30 companies, how many of them will benefit from the growing economic integration between China, Russia, and India? The answer is, out of the top 30, probably only 3 of them. You make your bets, you pick your horses. Today, everybody picked the AI horse. I actually think what's going to change the world in the coming decade is the growing economic integration between China, India, and Russia.
Yeah, big topic there. It was just the Shanghai Cooperation Organization meeting in Tianjin. Just I think it was 3 weeks ago, as you mentioned, and Modi for the first time in 8 years participated as well. So really a milestone, or a really important milestone meeting there, as you mentioned. But coming back to AI, one thing I've written down is like you're still very skeptical whether AI will return any profits. Like you mentioned that in January. Are you seeing any more clarity on that? Because based on what you just mentioned, is that you haven't lost your scruples about it.
No, and you could say, I've missed out on an opportunity, etc. But there's been other opportunities to make money, like you mentioned, gold. China's been in a roaring equity bull market, so it's. I look at AI. Yeah, I do remain skeptical on the ability of these hundreds of billions of dollars in investments to generate any kind of meaningful returns. I also think that the Googles, the Microsofts, the Facebooks have taken on a big risk because, part of what made their stock so attractive was that they were very capital light business models. These guys essentially generated huge cash flows with fairly little capital outlays. But this has now been massively turned on its head with all the money that they have to plow into AI. Essentially, they become as capital intensive as steel mills or auto plants. Except that the investment they make probably have a lifespan of 2 to 3 years. Within 3 years, a lot of these data centers are obsolete. Within 3 years, the chips are obsolete. And then before you go into the fact that, you look at Facebook, like writing $100 million checks to hire the best AI engineers, it's to me, it feels like I think a lot of this capital will have been found to be wasted by the time it's all said and done.
Yeah, I think one thing we talked about there in January as well is just the deflationary impact of China. And maybe we should talk about that in general because we got the Fed meeting looming over us, the FOMC's meeting as we speak here, Louis, talking about inflation and deflation. The deflationary impact of China on the AI space in general, like how would you rate that? Like how is China a bit of a counterbalance to what the US is doing in that regard? DeepSeek, we talked about, like I'm not sure what the latest numbers are, like what the development costs were. We were joking about the 6 million back then, but I don't think the numbers are too far off here. How do you rate that deflationary impact?
So look, my read on China is a pretty simple one, and that is that in 2018, when the U.S. did an embargo on China, the Chinese a semiconductor embargo, the Chinese leadership essentially panicked, and they said, "Okay, the U.S. is out to get us. We need to build domestic resiliency in every single vertical. We need to, build up independence everywhere." So the banks at that point were told, "Look, guys, no more loans to real estate. All the loans have to go to industry because tomorrow the U.S. could cut us off chemicals, products. They could cut us off auto parts. They could cut us off anything." And so for 7 years, no money was going to the consumer. No money was going to the real estate, and everything was going to industry, which was a huge, to your point, it was a massive twin deflationary impact. First, because real estate went bust, which led to balance sheet recession, Chinese consumers tightening their belt, etc. That was the first deflationary hit. The second deflationary hit was that China was adding massive capacity in every single industry. And so, out of nowhere, China becomes the biggest car exporter in the world and the biggest tractor and the biggest telecom switch. And yes, money is poured into semiconductors. And with that, and money is poured into developing China's own AI solutions. So, unlimited capital for essentially anything technology, anything industrial. But this is where I think right now you're seeing perhaps a very important shift in Chinese policy. The new buzzword in China now is anti-involution. Xi Jinping's given speeches on it. Every Politburo member has given speech on it. Now, anti-involution means basically anti-excess competition. And you could ask, what's excess competition? Well, essentially what the Chinese government is doing is telling the banks, okay, guys, stop lending to industry. We've now reached a point where we're strong enough and we know that the US can't take us down. We can produce everything ourselves. The ability of the US to curtail our growth is now much diminished. And so against this backdrop, China is no longer going to be adding capacity on top of excess capacity. So, if you believe the Chinese government, and for my sins, I tend to believe, I've been there 30 years, I tend to think that the Chinese government has a decent track record of saying what they do and doing what they say. So if you believe what they say today, that they mean what they say, that means that the deflationary impact from China should start abating from here, because they're pretty much done adding excess capacity on top of excess capacity.
Yeah, which brings me to the China stimulus package. It was just announced, I think, 24 hours ago, pretty much. I'm curious what your thoughts are, because it's something the U.S. has been demanding as part of the trade talks as well, just domestic stimulus. Let's get the economy going. Let's get the consumer more incentivized to purchase and just consume domestically and drive demand for U.S. products within China as well. What do you make of the domestic stimulus package in general, without even the U.S. angle?
Well, look, China is now in an environment where there is no inflation. Look, the constraint to stimulus is always inflation, right? And there is no inflation in China. In that respect, China is not that far off where the U.S. was in 2009, 2010. Inflation collapsing, low real estate prices, very low confidence. So you can follow very, very loose monetary policy, and if you choose to, very loose fiscal policy. And this is where China is today. China right now, this year, will probably be running budget deficits of around 10% of GDP, give or take. That, China's never run budget deficits this big. This is absolutely massive. And they're doing this at a time when monetary policy has never been this easy. So you're seeing massive liquidity injections, and for now, because economic growth isn't that strong, you're in an environment not that dissimilar to what you had again in the US 2009, 2010, where you're pushing excess liquidity in. And the default mode is for that excess liquidity to find its way into asset prices, most notably equity prices. I think that the playbook that you had post 2009, 2010 in the US is not that dissimilar from the playbook that you have right now in China. And so it's interesting because you get weak growth. And just like in the US in 2009, 2010, everybody was saying, oh my God, it's a new normal, growth will never come back. Or this. So you get weak GDP growth. So you get a government that does more, and you get equity prices that grind higher every single day, essentially climbing the wall of worry in the face of really nobody believing in it. There's other parallels, of course, but the bottom line is right now, Chinese growth is disappointing. The government is stepping up to the plate to stimulate more, and they don't really have any constraints to the stimulus they might want to put in.
If you were to put an economic, what do you call it, a buzzword around it, like deflation, stagflation, recession, what would you use for China right now, Louis?
Well, definitely not stagflation. We have no inflation. Look, I think in China, we are in a structurally deflationary environment. China is a deflationary force to begin with, but we've had these twin deflationary forces of busting real estate and excess capacity being put in. So we are in a very deflationary environment in China. The big question is whether you're in a deflationary bust or a deflationary boom. And the government is doing everything it can to move from the bust side to the boom side. And the stock market is increasingly behaving as if saying, look, I don't know when it is, but at some point, all the stimulus that the government is putting in will get some traction, because the government isn't going to quit, right? It's, again, they have no constraints. They're not going to turn around and say, oh, well, we tried. let's just turn ourselves into Japan for the next 30 years. No, that's not going to happen. It's going to keep being pedal to the metal. And so, yeah, where I think, where to answer your question, I think we're inching our way towards a deflationary boom in China, which incidentally is really the best environment for equity investors typically.
Deflationary boom. I'm writing that down for our YouTube title, perhaps, Louis. So
Go for it.
Might use that because you're the first guest mentioning that deflationary boom. Usually it's always in a negative context, but you make it sound like a positive thing, right?
Well,
can you add some more color to that?
On this, I think this is important. The natural state of capitalism is deflationary. Like every entrepreneur, every business leader, everybody wakes up in the morning wondering, how can I produce more with less? That's the whole point of capitalism. Less commodities, less land, less workers, I want to produce more with less. That's what we're all trying to do all day, every day. So the natural state of capitalism, you go through the whole 19th century. The whole 19th century was essentially periods of deflationary boom alternating with deflationary busts. That's the natural state of capitalism. And I think it took the era of fiat currencies and just massive money printing for us to change that equation of capitalism moving from deflationary boom, deflationary bust, and the growing welfare state as well. Now, my starting point when I look at markets is that most asset prices are driven by the interaction of inflation and economic growth. So that leaves you put them on a 4-quadrant axis. That leaves you with 4 possible scenarios. You can have an inflationary bust, what you call stagflation. You can have an inflationary boom, which is where I think most of the Western world is today, because we have, massive budget deficits that on top of massive government debt that are being monetized by central banks. So that's your inflationary boom. You have your deflationary boom, which is what I think you have in China. And then you have your deflationary busts, which is what you have had in Japan for 20 years, but you no longer have. But to your point, when you talk about deflation, most people in their mind, partly because that was the experience of the past 30 years, immediately go to Japan and imagine a Japan-like scenario. But, again, the 19th century, which was a period of tremendous economic growth, was mostly a period of deflationary boom.
Interesting. Yeah, no, it's true. We're going through that deflationary boom right now with AI. Meaning we're increasing productivity. Would you agree that's also part of that category, part of that game? Does that fit the definition?
So technology fundamentally is a deflationary force. Again, trying to do more with less. And here, this is at the heart of the question, and the big debate is how much productivity gain are we going to get with AI? If we get tremendous productivity gain, AI has the potential to indeed unleash a deflationary boom. When I look at the Western world today, what I see is, again, hundreds of billions of dollars spent into AI. And I don't really see either the returns on people's bottom lines yet, nor do I see really the massive productivity gains in our economy. If we had massive productivity gains, inflation would be trending down towards zero. What we have in the Western world is inflation actually, creeping higher. I imagine few of your listeners today are going around saying, there's so much deflation in my life. Assuming now that your listeners aren't in China, if your listeners are listening in from Europe, from North America, most of them will be complaining not of falling prices, but of rising prices wherever they turn, rising insurance costs, rising grocery costs, rising everything. So so far, maybe AI will be a big deflationary force for the world. So far, I just don't see it in the data.
Yeah, it might be deflationary on the workforce, but not really in any other way. We'll have to see how it plays out. Because personally, I'm seeing, and that's more of a personal anecdote, it's making my life a lot easier because I'm using AI as an HR consultant, marketing consultant, you name it, I use it for, right? And even just here for YouTube, it makes life a lot easier and simplifies processes. So tough to measure, but it feels like I'm getting a lot more done in a day than I used to in a week.
Oh, that I firmly believe. Look, I use AI as well, etc. But remember, those tools that you and I are using to make our day-to-day life easier are costing hundreds of billions of dollars. And so it's like, is that productive or not? Yes, you and I might save a few hours. Is it worth all the money if essentially Google or Microsoft and ChatGPT and OpenAI, etc., are spending, $500 for you and I to save $150 worth of work? Then that is not deflationary boom type activity. In fact, that is deflationary bust type activity, because what you're doing is lighting money on fire, and at some point that stops.
It's interesting because you look at different perspectives. For me, it's $10 a month. For Microsoft, it's $1 billion a month or something, right? So for me, that $10 is massively deflationary on my time. Yeah. Right. If that makes sense. Sure. So it's a perspective. Sure. It's an interesting discussion because it depends a bit on the angle as well.
But they're losing money on it. They're all losing money on it. So the question becomes, okay, if the right price should be $1,000 a month, are you still subscribing? Are you like, oh well, it only saves me an hour a day. I'll do that hour a day because I want to save the $1,000.
Yeah. No, good point. We'll cross that bridge when we get to it, and I'll make that decision once they raise prices there, Louis. But maybe one last topic here in regard to China as well. I mentioned the meeting in Madrid that is happening right now as well. What do you make of that? U.S.-China tariff talks, we've seen a TikTok deal come out of it that seems to be satisfactory for both sides. What do you make of the discussions? I mentioned in the intro, germanium trade is being halted, so the Chinese are already like pulling on some levers here to exert some pressure. What do you make of it?
So I think the U.S.-China tensions are essentially over. I think that the big period of essentially yanking each other's chain is now done for. And going back to what I was saying earlier, the semiconductor embargo of 2018 was the defining moment. When that happened, and essentially the U.S. came out swinging against China, China took the punch. Like they took the punch and they rolled, and they said, okay, world has changed. We need to get ready. And in 2021, the U.S. came out swinging again. You had the Anchorage meeting with Blinken, Sullivan, Wang Yi, and the U.S. came out swinging. And again, China took the punch. And this time around, Trump comes around in 25 and doesn't just punch China, but really punches absolutely everybody out there. And China at that point is the only one that stands up and says, you know what, I'm not going to take this. And I'm not going to take this, and fights back, increases tariffs on the U.S. And then to your point says, look, we're going to ban rare earths. We're going to ban magnets. And at that point, the U.S. realizes that while China's been spending the past 7 years getting ready for this fight, the U.S. has not done that. And that within 3 weeks, the U.S. is going to run out of missiles. And without the Chinese rare earths and magnet, they can't produce anymore. They're going to run out. The GM plant is going to have to shut down because, again, no magnets. And so at that point, they meet in Geneva, they de-escalate, because deep down, for China to ban the rare earths, for China to ban the magnets was a very non-Chinese thing to do, because the default mode amongst Chinese policymakers is always to try to diffuse crisis. The Chinese policymakers are first and foremost in the game of social stability. They want to keep peace domestically. Partly because of history. You look at China's own history. They went from 1850 to 1975. China was probably the worst place in the world to live. You had foreign invasions, you had famines, you had economic disasters, warlords, anarchy. It was a terrible, terrible place. And as a result, social stability comes at a huge premium in China today. So for the Chinese leaders to come out and amplify a crisis is extremely unlike them. But so they did it. The U.S. backed down. And now you'll have noticed probably that since that April meeting, nobody talks about Taiwan anymore. Like Taiwan used to be all over the Western media. You could not open your paper without being told that China, it's either this week or next week that they're invading. Now nobody talks about it. Now the U.S. Defense Department, the Pentagon, just released a white paper saying that, look, we can't really be an Asian superpower, actually, because in an age of drone warfare and hypersonic missiles, our Navy actually doesn't mean very much. So what we need to do is refocus on the Western Hemisphere, controlling the Americas and leaving it at that. So the bottom line is the firing has stopped. Now you just need to sit down and work out a face-saving deal for everybody. China will be very happy to have a face saving deal because, again, they're in the game of stability. They just want a stable relationship with the U.S. Xi and Trump will be meeting at the APEC meeting in Seoul in late October. Maybe Trump on his way there will even stop in Beijing. Either way, by late October, I think you get some kind of deal. And yeah, I think like this was a big story a year ago. I think that's dead and buried now. Can move on.
Some fantastic insights, because I wasn't fully aware of the APEC meeting here, for example, as well. So that's some good insights there, Louis. Really appreciate that. And now I'm trying to tie that to what's happening at the Fed this week. Lots of topics and very little time. Let's use the last 4 minutes to sort of get your opinion on what should the Fed do, because the tariffs, of course, are inflationary for many of our guests here on the show. And the Fed is, of course, looking at the inflation data. Now, what should the Fed do in light of what you just mentioned in terms of coming from the geopolitical side, from the tariff front? What should the Fed do?
To be honest, I'm not sure I even care. Look, I think we've lived in a world that was all U.S. dollar dominated, all the time. And yes, in such a world, what the Fed did next mattered a lot. Now, you could say, oh, well, are they going to cut 25? Are they going to cut 50? I don't really care, because what's increasingly visible to me is that you have a U.S. Debt that's out of control, and by hook or crook, it's going to get monetized by the Fed. That's the direction of travel. That's where we're heading. We're going to have a Fed that is increasingly being merged with the U.S. Treasury. So whether we get 25 or 50, this week. It's like what matters in terms of mega trend of the overall direction of travel is you're going to keep getting debt monetization. The U.S. dollar is now it was structurally strong, is now structurally weak, and to be honest, the Nvidia results are now much more important than what the Fed does, because the day Nvidia disappoints is the day the shine comes off the AI bubble, and it's the day that the dollar takes a big step down. I think the Fed is becoming a sideshow.
Yeah, just looking at it from the mining perspective, and that's where we come from here as well. Like a lot of nervousness around that Fed meeting, because gold is at 3,700. The mining stocks, GDXJ, all-time high right now. We all fear a massive rug pull, because we all got that massive bear market mentality. If I look at my portfolio, it seems like a lot of people are lightening their not lighting their positions on fire, but lightening. No, what's a curl?
No, lightning. You're right.
Shedding some weight maybe in their portfolio. I don't know, like whatever the right term is here.
Look, that part makes sense, right? You look, I think the GDX RSI right now, 30-day RSI is like 85, which has never been before. And to your point, I think if you've been a GDX investor, you're carrying some wounds over the past few years. You're carrying some wounds that have yet to really cauterize. There, like some of them are still pretty open. So you're not used to having such massive profits in such short periods of time. So you can see how the temptation to take some off. And yes, you're pretty oversold. Could it pull back? Absolutely. But if you project yourself 1 year, 3 year, 5 year down the road, is gold higher or lower than it is today? Is the GDX higher or lower than it is today? And I think the answer is it's higher. When I look at gold, I'm still stuck with the problem that, you have central banks around the world that are now a massive buyer, and they're a price insensitive buyer. You have retail that used to sell, the GLD share count kept shrinking, retail that's now buying. And frankly, there is no supply. Like there is, like the GDX has had a great, whatever it is, 3-4 months, but it's had a horrible decade. So
15 years of bear market.
15 years. So these, like, if you've been a gold miner, you've had zero access to capital. So there's zero capacity coming in. So yeah, sure. Sure, the Fed could do a rug pull. Then again, the Fed could do 50 basis points. And I don't know, and you don't know, and we'll see. But the Fed could do a rug pull, and yes, you may want to take some profits today, but again, it's like gold is in a bull market. Precious metals in general are in a bull market. GDX is in a bull market. In a bull market, you're either long or you're on the side watching it, you definitely don't short. So today, these things are in a bull market. And so, yeah, you can take profits, but I still think in a year, 3 or 5 years will be high.
Absolutely. No, fantastic. Louis, awesome last words. I think that's what we all wanted to hear. We need some confidence going into this tomorrow. And this interview will actually come out here today on Tuesday as we're recording this, Louis. So I really appreciate your insights. Always fantastic to catch up with you. We could chat for hours. I love your insights here. Louis, where can we send our audience to follow more of your work?
Yeah, the easiest is our website. So gavekal.com, Gavekal. I also happen to be on Twitter at Louis-Vincent, which is my middle name. But I don't post very much. So the best place is to go to Gavekal.
Fantastic. Awesome. Louis, thank you so much for joining us. It was a great pleasure to have you back on. And everybody else, thanks so much for tuning in to Soar Financially. How are you playing the Fed meeting tomorrow? And what do you make of the U.S.-China trade talks? Is it all over already? And this is just a face-saving mission for both sides? Really curious what you think. Put it in the comments down below and let us know, how are you behaving in the mining space right now? Are you buying? Are you selling? Are you holding going into the Fed meeting? Really curious your thoughts. Thanks so much for tuning in. Don't forget to hit that like and subscribe button. It helps us out tremendously, reaching a wider audience, and we much appreciate it. Thank you so much for tuning in. We'll be back with lots more. Stay safe out there.